Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with Malcolm Ferguson of Octopus Ventures to talk about Octopus Titan VCT. Hello, Malcolm.
Hi there, thanks for having me.
A pleasure. Tell me, first of all, about Octopus for those who aren't familiar with it.
Yeah, so Octopus Ventures have been around since 2007, and we're best known for managing the largest VCT in the UK, Octopus Titan VCT. We have one of the largest investment teams in Europe focusing on technology.
And what about yourself? How long have you been at
Yeah.
Octopus? What do you do?
So I was lucky enough to join Octopus back in 2013, so I've been here for 7 years now and I'm a partner in the team. Before Octopus, I had the joy of working in investment banking for a period of time, first with Bank of America Merrill Lynch in the TMT team, and then I moved to a technology boutique called GP Bullhound, which focused actually on helping entrepreneurs of high growth businesses raise money from VCs like me now and sell their companies.
Tell me about Octopus Titan. What does it aim to do for investors? How many companies do you invest in?
So Octopus Titan VCT aims to provide access to the venture capital asset class for retail investors. It's a fascinating asset class because it's one which is typically restricted to professional investors, ultra high net worths and institutions. But Titan VCT levels the playing field. It gives everyday investors the ability to access it. So Titan VCT has been investing since 2007. We have 80 portfolio companies and we're looking to invest into the best tech and tech-enabled businesses in the UK.
You say tech-enabled businesses. What else is the criteria? What do you look for in a company?
We're essentially looking to back pioneers. We want to back pioneers who want to change the world. It's a pretty lofty mission, and we deliver that through a pod strategy. So we have individual sector teams. We have 4 of them, in fact, focused on the future of money, the future of health, and deep tech, and then consumer, which we added this year. And they look to make investments into their specific verticals. We look for a few things in particular that's common across all of those companies. They have to be very ambitious, very pioneering individuals who are usually very focused on building a very big business. They also have to be operating in a very large market. So we're looking for £1 billion market opportunities, which are actually surprisingly rare. And the final piece is we're looking for technology-enabled businesses. And technology-enabled is important because it enables you to grow businesses very quickly, which is not possible with more traditional business models.
And how do you find these opportunities?
So we look for it in a variety of ways. When we moved to our pod structure back in 2018, we tweaked it also. So we have each pod member generates a thesis, they generate knowledge network, advisor group. So we have a very specific approach within the future of money, which is different to deep tech. We have a network of advisors, we have angels, we have seed funds that we build networks with. We attended in person in the old days and now on Zoom, all the demo days that exist. And we have a really well-established group of people who share deal flow.
And is there a particular stage of business you look for?
Yes, indeed. So we primarily invest at the earliest stages of our company's life. Seed and Series A are the labels. We also do some Series B. And what does that mean? That means at the earliest stages, potentially as little as a pitch deck, through to early scale up within a company's life.
When you're looking at these companies, are there any sort of red flags which say, no way, we won't go near that?
So we say no to probably 99% of the opportunities that we see. So we're looking more for very specific traits in the companies rather than red flags. There are always certain things we don't love. Me Too businesses, we don't like where we feel that an entrepreneur will sell probably too soon in their journey. It's so hard to build these businesses that when you find something special and the big acquirer comes and offers you tens of millions of pounds, which could change your life as an individual, for a VC, that's a failure. We want to see these businesses grow onto their potential, which is billions of pounds of value creation.
Okay, tell me about the some companies you've made investments into recently and why you've done that.
So we invest in somewhere between 10 and 20 new investments each year, which is 2 to 3 per pod. I'll pull out a couple examples. So Tax Scouts, which was an investment out of the Future of Money pod. It was founded by 3 individuals who were from two of the largest tech fintechs out of London, TransferWise and Market Invoice. And they decided that the 10 million people that have to do a tax return every year in the UK, actually over 100 million if you look at Europe, they have 2 options. Either you do it yourself, which is tedious, you often make mistakes. There was over $1 billion in fines last year for late submission, so that clearly that isn't working, or you pay up and get an accountant. But most people don't want to do that either. So they've created a middle ground where they automate all the most tedious parts of an accountant's role that they don't really want to do: onboarding, KYC, information gathering, filling in the self-assessment. They automate that, and they leave the accountant to do the most skilled piece and charge you only £100. So they automate all that process, and they have hundreds of Trustpilot reviews on that. We made an investment called Skin and Me. So the chairman of that business is a guy called Graham Bosher, who you may have heard his name. He was from Love Film, which sold to Amazon, which we backed. And then he moved to Graze, which sold to Unilever, which we backed also. And then finally Tails.com, which we sold to Nestle. This is the fourth business that we backed. He was the chairman. And they're essentially creating this personalized skincare brand where they can treat anything from acne through to aging, using a team of dermatologists, pharmacists and prescribers. So they're really changing the way, instead of going to Clearasil and Boots, a generalist thing that doesn't really work for anyone, they have a specialist approach built by experts that are delivered to your postbox.
Perhaps you could also give me some examples of some older companies that are doing well.
Yeah, so we're really proud of the portfolio we've built. We've been handpicking these companies for the last 12 years now. One of them that stands out in particular is Cazoo, which is a business founded by an individual called Alex Chesterman, who was, if you've heard his name, he was also the founder of Zoopla, which was the first £1 billion business backed by a VCT, which happened to be ours, Titan VCT. His next business is Cazoo, which sells used cars online. We invested in 2018 at the end. He launched the business at the end of 2019, and it's already generating over 100 million in revenues. It was the fastest ever UK company to get to a 2 billion valuation. So we're really proud to be able to support him again for the third time, actually. Another example is a company called Bought by Many, which is a pet insurer that we first invested into in 2017. They launched the product that same year, and it's now grown to be one of the top 3 pet insurers in the UK and one of the European success stories within InsurTech, which is one of the areas that the UK has become really strong in over the last few years.
And how's the pandemic been for you and your portfolio companies?
So it's been a fascinating time to be an investor. Clearly, it's terrible from a societal and economic point of view. The pie has got smaller, but where we are quite fortunate as technology investors is that this is one of the verticals where there has been a silver lining. So what we saw, to just give you a very specific example, for e-commerce in the UK, in the 10-year period to 2018, we increased the proportion of sales online by 10%. So it became 15% online. In 2020 alone, we got another 10%. So we had 10 years worth of digital acceleration in 2020 alone as a result of this. So we're rethinking how society works. That is fantastic for early stage, nimble entrepreneurs who find opportunities in the mayhem. So we have seen opportunity being very exciting, and we're seeing a lot of good stuff. Within the portfolio, we've had some real beneficiaries. Cazoo, one of them, where people are less happy to go to car showrooms and therefore they buy online. But we've actually seen a number of our larger holdings see real benefits, where the incumbents suffer more than the nimble startups. They're built to go remote, and so they're much more able to adapt. Clearly, we have seen some examples on the other side. Travel, hospitality, leisure are clearly the most hurt. We hope that's a temporary problem, because the companies that make it through are going to be stronger and from a relative and an absolute point of view.
So in those cases, no doubt you've probably had to put some effort into helping those companies. How involved do you get with your investee companies?
Yes, so March and April were very busy months. We went from monthly or quarterly board meetings to weekly ones to help redo the business plans, understand the runway, understand what options were available as of furlough schemes, for example, the government schemes. As a larger venture investor, we've also allocated some of our resources to portfolio functions. So we have a portfolio talent team of 3 people who are helping our CEOs at that time navigate some of the challenges that many of them hadn't faced before. And also having 80 companies means that we can learn a lot of the lessons that others are innovating in. So we're trying to help essentially raise the tide for everyone, leveraging the innovations that people had seen. So it's been a fascinating time.
And so you've just had another exit. Do you want to tell me about some recent exits?
We have, yes. The last 12 months have actually been great for us. longer term, we've sold businesses to most of the big tech companies, Microsoft, Google, Amazon twice, Twitter, Nestle and Unilever were two big exits we had. In the last 12 months, we've sold 4 businesses that have returned material sums back to Titan and to our investors. And Calastone, the company was founded in 2007. We invested in 2008, so it was one of the first Titan portfolio companies. Fast forward 12 years, not 12 months, and the company has returned 18 times the initial investment and 9 times the overall investment. So it was a 30% IRR, which is testament to what you can build with patience and how long actually it takes to build some of these really great companies.
And would you say that would be typical?
So when we invest, we're targeting a 10 times return on initial investment. We need to believe that is possible.
Yep.
What we do know is of the 10 or 20 investments we make, only a handful will go on to achieve that aspiration. So Calastone is a great example of that, what's possible, but there is mixed performance in the portfolio, and the beauty of venture is actually only a small handful of companies tend to drive most of the performance.
So in the portfolio, how many companies do you expect to fail?
Yeah, so if we look at every investment we've made 120 investments since 2007, and 21% of those have lost money, which actually is quite a low number. If we look on a capital point of view, so that was a number of investments, as a capital invested, it's only 13%. So that's quite a small number. The asset class, on average, tends to believe in 50% failure being acceptable. The interesting thing is returns aren't really affected by failure rate, they're affected by the success of the winners.
Okay. So you talk about exits. So what does that actually mean for investors, overall performance?
Performance has been solid. We took a decision back in 2016, 2017 to materially increase our portfolio size and therefore raise considerably more capital. The consequence of that is in the short term, we expected some NAV erosion, which has played out. What we did see in 2019 was our best year in 5 years, actually, which was seeing the bets we made in 2016-17 start to come of age. So we saw good performance in NAV, higher even than the dividends that we paid, and we saw some correction there. Clearly in 2020, we have seen some impacts of COVID, so we took some provisions in April around our travel holdings. But actually since then, the portfolio's continued to improve, so we're now almost at the heights of December 19.
I suppose some problem, you do get a lot of exits, but now arguably the fund is so big that those exits have to be absolutely huge to make any sort of dent on the NAV. Is that true?
So our target is to deliver 5p dividends to our investors. The beauty of having a big VCT with lots of companies is it reduces the volatility. So what we won't get and what we're unlikely to deliver for investors is very large annual returns or very large annual losses, but we will generate more or less a 5p dividend, which we will target. The nature of the VCT means we have a lot of bets which start to generate returns for our investors. So although we are large, we're only the 8th largest venture fund. So we're large compared to venture capital trusts. But actually, compared to the venture capital landscape, which is where our true competition lies, we are large but not the biggest, actually.
And finally, if I want to invest in a VCT this year, why should I invest with Octopus Titan?
Yeah, good question. So Octopus Titan is the biggest VCT. It's 900 million assets under management across 80 companies. So as a new investor into Titan, you get exposure to all of these companies, including some of the ones we've just talked about earlier, some of the hopefully industry or generational defining companies within technology. By investing, you're looking to achieve an income through dividends, which you could reinvest, and that's what we've been delivering over a period of time since we set that target. So you get a somewhat predictable income stream and much lower volatility than you would get in a much smaller VCT or an EIS.
Malcolm Ferguson of Octopus Titan VCT, thank you very much.
Thank you.